Perfect. And we're on. All right. So everyone, welcome back to WorkSmart Live. Today's session is called To Be or Not to Be. And I'm Dawn Church. I'm WorkSmart's events manager. Thank you all so much for being here. And a big thank you before we get too far to our friends and clients over at the Durham Chamber of Commerce for partnering with us on this series again to make all of this content available to the local chamber members. And I'm going to introduce these guys in a little bit, but while I'm at it with all the thank yous, I want to say thank you to Jay and Dan from Viking Mergers and Acquisitions for being our guest speakers today. So we're excited to have both of you here.
Thanks for having us.
Thank you.
Yeah. Alrighty, so this week we're stepping a little bit outside of technology, just a bit, to talk about business acquisitions. And this, I understand, might sound like we've stepped so far outside of our wheelhouse to be really outside of the bounds of WorkSmart. And I hear that, especially at first glance from an outsider's perspective. But what we're really talking about here today is well-rooted in one of WorkSmart's core values, of which we have three. And they are personal connections, do the right thing, and hunger for growth. So growth here at WorkSmart can take a lot of different shapes, whether it's personal development, professional development, new certifications, but the most important part for us isn't even what we do so much, it's the hunger, it's the drive to grow. And it's the always looking for new opportunities in which to do that, whether that's as individuals or professionals or as an organization. And for us, one of the key parts of our organizational growth strategy has actually been business acquisitions. Really, since we started, we've been in business for 19 years, and during that time, we've grown through acquisitions 5 times, which is crazy. That's like every 4 years. My mental math is working today. So we're familiar with this process and its many benefits, and we love growth, and like our whole way of being is structured around helping us grow as individuals, as an enduring organization, and helping our clients grow. So we may not be familiar with the ins and outs of this as much as our guest speakers today, and those are Jay Offerdahl and Dan Wilson, who are respectively the president and managing partner at Viking Mergers and Acquisitions. So this dynamic duo is going to talk to us all about everything we need to know in respect to buying and selling right now. And speaking of the dynamic duo, we have my fabulous friend and co-host, Marissa Wayman, who is WorkSmart's marketing manager, again here today. She'll be helping answer questions and do all the things. So send us your questions as we go along. And Marissa, you can kind of take it away in tandem with Jay and Dan. And
yeah,
let's get going.
Awesome. Well, just as Dawn said, we're excited for everyone to join us. I don't have a lot to say this time around because Jay and Dan are going to do most of the talking. But just that key part that small businesses need to continue to look for those opportunities, especially in these economic uncertainty times, you know, whether it's survival or it's growth. Having friends like Jay and Dan at Viking definitely helps us bring that advising to you. So without further ado, Dan and Jay, I'll hand it off to you.
Yeah, thanks, Dawn and Marissa, for having us. We got to do a little bit of chatting on a previous webinar, and we're looking forward to kind of collaborating with you and the people online on questions and comments and concerns that they have during this time, especially during this time period. And, you know, Dawn, you referenced about not knowing a lot about it. And what's awesome about this industry, it keeps us constantly engaged in challenges, is we're still learning. I mean, 24 years into it, you know, we've seen, you know, the .com, we've seen September 11th, we've seen the Great Recession. And now we're seeing the pandemic, and through all those we learn, and that's an important part. And we're still learning, constantly still learning. So hopefully we'll be able to share some basics. That, you know, we never try to get too fancy or use words that I can't spell anyways. But Dan and I are going to share a little bit about our thoughts on, you know, the small business community, you know, how we got into it, why we got into it, what we're seeing, what to expect, how to prepare yourselves, and then hopefully leave some time for questions and answers.
So on the note of questions and answers, I just posted a poll to all of your screens. It's just a quick one so we can kind of get a little bit of a gauge on what it is that you're looking to hear about today.
Well, so far buying is leading, and growth through acquisitions is a great way to grow. I know WorkSmart's done that, and I did that with my previous business before joining Viking, and it is a great way to grow.
And Jay, whenever you're ready.
You ready for me?
Yeah, you can share your screen.
Let me do that. So, one of the things we kind of use this to be or not to be, or to be acquired or to acquire is kind of the theme for this year and during this time period. A lot of the business that we represent and talk to are deemed as essential. So a lot of our clients and future clients have not been impacted the same way hospitality, restaurants,
Bars.
retail, bar, thank you, have been. So it's been, obviously challenging, but we've also seen a lot of these businesses persevere through this time period. We also have seen, new businesses that will emerge from this. And, we got into this 24 years ago because my father had bought, grown, and sold 3 businesses and just thought there was a need for more professional representation for that closely held business owner. So Dan and I are going to kind of explain some of the, seller facts of what's out there, hopefully educate people or remind people of things that they may not have been thinking about. And to Dan's point earlier, after he had started a business and bought a business and merged in a business and then sold a business, some of the reasons you approach that, because we kind of joke, it's not a joke, but the reality is oftentimes you can buy more business in 5 minutes than you can grow organically in 5 years. So about a third of our transactions are actually strategic buyers, people already in business and trying to grow through acquisition. So kind of kick us off, Dan, if you don't mind, giving some people some little background on the stats out there.
Yeah, let's start with some stats so everyone has a kind of a baseline of where we're working with. There are 30 million plus small businesses around the United States, what we call single shingles. About 6.7 million privately owned businesses, and plus or minus 4 million of those are owned by baby boomers. And one of our recent blogs was directly related to baby boomers. We called the Silver Tsunami. All the boomers will be turning 70 by the year 2034. So a few stats with that: 75% of small business owners' net worth is tied up in the equity in their business. 75% don't have an exit strategy or a succession plan. And 75% of those businesses brought to the market do not sell. And there are many reasons for that.
Yeah, to Dan's point, that 10,000 people a day, people have forgotten how big number those baby boomers or silver tsunami, I love that term, make up of the population. And to Dan's point, a big percentage of those are the ones that own those businesses. We kind of deem as kind of like that $1 million and above, you've kind of hit that critical mass, maybe as high 6 figures, but definitely low 7 figures when we use that number, about 6 to 7 million. What people don't realize is how often small businesses actually change hands. And not to get too deep in the physiological part of owning a business, but we often say that the only reason you start a business is to set up to sell it. So if you have that mentality, yes, there's different things of creating your own destiny and being your own boss, and there's obviously financial benefits of growing equity and certain retirement accounts that business owners have access to that other people do. But the reality is that's an asset, like a stock, bond, mutual fund, whatever, and you need to approach that way. So the average business changes hands every 10 years. The restaurant industry brings that number down, so it's probably half that, and then a manufacturer may be 15, 20 years. But the reality is when someone's buying a business or starting a business, their thought process often goes to leaving a legacy. Hey, I want to give this to my children. And we kind of joke with things like that. Is that, you wouldn't give your teenager the keys to a fast sports car because there's a high probability something may go wrong. Similar to small business, once it changes the first generation hand, the second generation has a 20% less likelihood of success. By the third generation, it's a whole bunch of funny jokes about what happens to the third generation. So the mentality is having that decade thought process when you own a business, that you should really have that reality check. The other thing is most people don't understand how businesses are valued. And 99% of the time, it's based on cash flow. And we get this question all the time is, what does cash flow mean? Does that mean net income? If you come from a big company, you talk about earnings, like public companies, is, what's the PE ratio? Smaller businesses is cash flow. So it includes the earnings, which is also known as net income. But if you're not a CPA and you haven't heard the terminology EBITDA, it's basically taking your net income, you're adding depreciation, interest, and amortization, and you add to that the owner's benefits of running that business. And that's kind of what most people define as cash flow. You may have also heard the acronym SDE or SDC. That's seller's discretionary cash flow or seller's discretionary earnings. And the reality is you need to know that you want to maximize shareholder wealth the same way a public company does when you're getting close to selling it. When you're first operating, most business owners' goal is to minimize your tax consequences, put as much money in their pocket. But we can show you on paper why it makes sense to really run your business and maximize that cash flow. And they'll sell for a multiple of that. The multiple is the inverse of risk. And so Dan will talk a little bit more about things you can do to try to minimize that risk to maximize that multiple. And the only kind of outlier is SaaS company, software as a service. If you're growing at 30% and you have a true SaaS, which is 7 figures in top line revenue and higher, and you're growing at 30%, those businesses actually can get a multiple of revenue. But besides SaaS, and I guess you could probably throw in like insurance agencies and financial analysis companies, or advisors, financial advisor businesses. Sometimes they'll sell for a multiple of commissions, annual commissions, but most of the time you're talking about 2.5 to 5 times cash flow, 4 to 10 times EBITDA, and that's really what we want people to focus on as they operate their business.
Now there are a lot of key people. Go ahead.
We had a couple of questions come in.
Great.
Yeah. So in regards to some of those stats on business buying, I think it was the slide before that, and then the sellers as well. So the first one, you mentioned, and this is again a good point to point this out. We mentioned in our email yesterday the 75% rule, and I don't know if you caught that, but there's a couple of different places where that 75% is really relevant to business acquisitions. But one of the things that you said was that I think you said 75% of businesses brought to market fail to sell, and somebody asked why. Can you elaborate on that a little bit?
Dan, you want to take that? You want me to take that?
Jay, you take that. You have a lot more years of experience than I do with that. So,
and that 75% is kind of, we use that number. It could be 68%. It could be, but rough numbers, just so everyone doesn't fact check us and say, oh, they're not right. So we're basically saying it so you can remember this, roughly 75%, all those things. A lot of that information comes from the IBBA, which is International Business Brokers Association, and also Biz Buy Sell, which is a large business for sale website. And my belief is most businesses don't take the time up front to prepare to sell. And so they may not have realistic price expectations. They may not have their financials in order where they're going to be able to complete a due diligence test from a buyer. And not to get in the weeds on due diligence, but due diligence is an opportunity for a buyer to assess risk. And when they're assessing that risk, they're going to look at it from different angles. Some people are very high level. They just want to know that your bank statement ties into your P&L, ties into your tax return, and they're great. They know what they can do with the business, so not digging into some of those stuff. Some people we've got, and Dan's seen it, a lot of our guys see, 3 pages, single type list of due diligence questions. And it gets into HR and legal and how they're duly organized. And they want to really dig into the reps and warranties, dig into the vendors and customer lists and, customer concentration, vendor concentration. Just a lot of detail. And I don't think many small business owners are prepared for that. If they're like me, it took me 18 years to start actually working on my business. The first 18, I was wearing every hat. I still, tell people all the time, I'm not above cleaning the men's bathroom. I don't like to do that, but that reality is the last thing a business owner has in mind is like, okay, how do I set my business up to sell it? And so they go to market. They probably not have a realistic price expectation because they don't have a real valuation on their business. They don't have the right people in place organizationally to help them with that. So they're trying to run a business and simultaneously trying to figure out all the information they need to gather for that buyer. It just time kills deals, and over the time, a lot of those businesses just they fall apart. And then a lot of business owners, it's like you hear about the sports analogy. They take their ball and go home. One buyer kind of backs out and says, I'm not going to buy your business, and the business is like fine, I'll just keep it. So they're just not prepared to go to market, and it's sad because then a lot of times it takes the wind out of the sails, and you can actually see where they're almost feel defeated.
Mm-hmm.
Yeah, there's many times when we have a business that we have listed that we'll go through 1 or 2 or 3 buyers to find the right buyer to be able to maximize the value and the price that the seller is going to be able to walk away from the table. And a lot of times that first buyer is not the right one, and that's okay.
I have a quick question. It's a little bit, I think it kind of pairs with it, but it's a little bit of a tangent. So I talked with Clay prior to this event. This is something that Don said, growth strategy for us includes mergers and acquisitions. We usually fill that role as the buyer. We have always filled the role as the buyer. And we're always looking for opportunities and therefore can be selective and relatively selective when it comes to potential acquisitions. Is that, you talk about the success of a sale. Is that something that affects that as well, that these buyers are looking for very specific things?
I mean, definitely in a situation like you have, your company is looking for a cultural fit, right? You're big enough now that you don't need to make an acquisition. But if you find the right one that's got the right culture, it makes complete sense. You can recognize economies of scale. So hopefully 1 + 1 = 3. And so that's why 1/3 of our transactions are. And I'm not trying to scare people on that 75%. Our stats are the opposite. We'll sell 75% of the engagements we take, but we do a tremendous amount of work up front to ensure there's realistic price expectations. They understand what's going to be expected of them during that due diligence time period. And so, hopefully they're more informed what's going on. And even of the 25% that we don't sell, the vast majority of the time, we still have an offer that the seller could take, but it may not be one that they feel like it's worth taking. So, it is for you guys a cultural fit, but it is hard for buyers right now, I think, because it's still a seller's market. And I don't know if that will ever change. Even if the baby boomers come out and grows, and if the 10,000 a day are turning 70, that probably means 10,000 a day are looking to retire also. So unless that just really increases, we have exponentially more buyer inquiries on a monthly basis looking to buy that good business than we do have clients to show them. So oftentimes, and Dan had a closing earlier this week, and there was multiple buyers circling around that business and some of the other ones he's working on. And so they are in competition more so than where the sellers are begging them to buy.
Yeah, Marissa, to further answer that question, there's 3 types of buyers out there, and each of these types of buyers are looking at the business that they want to acquire in a different way. You have individual buyers who are looking for the right fit that's going to fit their personality and what they want. You have a strategic buyer, which is like WorkSmart, being a strategic buyer, which is looking for cultural fit or geographic expansion, or maybe even product expansion. And then you have the private equity groups who are really looking at EBITDA numbers and looking at profit as a primary driver. So depending on what the buyer type is that's looking at the business that you're selling, you're going to have a different personality coming in as a buyer.
That makes sense. That makes a lot of sense, that it really depends on where you are as a seller, what you're motivated for, and then as well as the buyer. If you have that opportunity to be more selective, could be beneficial to make sure you have a culture fit if that's where you're looking for, but can also kind of impede that ability to make a transaction to grow.
Yes. Now we're the people in the transaction. If you're looking at selling, you need to have some people on your team and your dugout so to speak. And these people include a CPA, and the CPA to help you with the tax advice, to even walk you through things like price allocation when you're doing the actual closing documents, so the taxes work out as much in your favor as possible. You need an attorney to help with legal advice, and we highly recommend that this attorney has experience with mergers and acquisitions and transaction type documents, and they're not just their attorney you use for just an estate planning. Now, having an estate planning attorney, if this sale is going to be a really big one where the estates need to be thought about, that's definitely someone. A banker who you have a relationship with, and you should be involved early with that banker on these discussions. A financial planner to help determine how these proceeds are going to be invested is really key. And any type of consultants that's going to help you organize your business, and the things that you can do, the things that you can get, the things you can't do or don't have the time to do. Because if you're a sole owner of a business, Jay brought up the due diligence sheet. You want to have some people on your team that's going to help you create and gather that information that the buyers are looking for in due diligence. And if you're married or have a significant other, buy-in from that significant other, your spouse and all that is without a doubt something that you want to have in your corner.
Important part of what Dan was alluding to also is we have found many business owners, very confident in their decision making when it comes to running their business, but oftentimes when it comes to this, specific, selling their business or whatnot, it's the first time they've done it, and it's a very emotional thing. So you think about getting married and having kids and lost a loved one. I mean, buying and selling business are right there in those same type things, and so it's very important that with the people on your team, that you ask the right people the right questions. And Dan alluded to having the right attorney. Well, if you have a litigator that's your buddy, they're going to come with a steel hammer and try to pound through things, and that's not always beneficial. And we've seen legal tabs that were exponentially higher than they should have been just because they had an attorney that just loves conflict. And I've got a lot of attorney friends, so I say this in tongue in cheek, that just because you pass the bar doesn't mean you know everything. So you make sure you ask the right people the right questions. And when it comes to buying and selling a business, you need to ask fellow entrepreneurs. And if the best thing you can find is that CPA who's actually an entrepreneur that studied accounting, and that entrepreneur that happened to go to law school. I mean, those are the ones that are pro deal. They're going to protect your interest. They're going to protect you, but they're going to give you sound business advice, not just legal advice. Because a lot of attorneys, and their job is to tell you worst case scenario. Well, if they constantly talk about the worst case scenario, and this one word totally changes the whole reputation warranties of this agreement, and they can scare business owners, and they'll get paralyzed. So make sure you're asking the right people right questions. And then on the significant other, as Dan spoke to, and I say this as a humble business person, I'm very confident in what I do here at Viking, but the reality is I'm an insecure male that needs my wife to tell me in the morning that I can, go get him, Tiger, and then give me a hug when I get home to say thanks for all you do. And so those two things seem trivial, but being a business owner is lonely, and you want to be able to have the support of people around you to kind of tell you, like, you've got this, you can go do this.
So how does someone find the right resources? We talk about needing the right lawyer, the right advisors. Where do they start?
We can tell them. But
you might be able to.
When you're everyone on online now, you can find out what their strengths are. So if most people already have like an attorney that's helping do something, set up their corporation or help with an employee or a lease or a legal, something that's happened. And if you go to their profile, they normally will write down what their strengths are. It's going to say, domestic if they're into family stuff, domestic family. They're going to say litigation if they're in this, or whatever that is. If you don't see anything about mergers and acquisitions or asset purchase agreement or small business law or things like that, then you just got to ask, maybe ask them, like, who do you recommend? If they're your best friend, you're not going to hurt their feelings. If they're your best friend, they care for your best interest, they're not going to say, oh yeah, I can wing this. I'll read up on it. Like, no. and what I tell a lot of people, and depending on who's out there, I hope I don't offend anybody, but you want the oldest attorney because they have wisdom and they don't need to prove themselves anymore, right? They've been in and out of things, and they're there to provide you that. I mean, everyone's got to start from somewhere. I started at 22 in this business, so people say the same thing about, oh, Jay's too young to help you. But you want that, and then forget about this. But the other side I say is you want the youngest doctor, right? The person is cutting edge, right out of medical school. So if you apply that same logic to some of the things with your key people that are on your team, you can come to the conclusion of who's been there and done that, and who don't want on my team, and who's easy to deal with. That's going to make sure that I want to close this deal, I want to buy this deal, and don't let those trust advisors screw up something that you want.
Yeah, another place to start, if you're a little bit of a do-it-yourselfer at the start, most business owners probably have a CPA that they've been doing business with for a while, and maybe a financial planner. Go to them. I guarantee you, your CPA knows an attorney who does transactions and M&A. They know a financial planner, or your financial planner may know the CPA. That's always a good place to look. And like Jay alluded to at the beginning, there's 36 advisors throughout our 8 offices around the Southeast and Viking, and each one of us has a long list of CPAs and attorneys, bankers, financial planners that we'd be more than happy to get you in touch with that are in the area that you're in. Now, preparation as a seller, and I can definitely speak from experience with this. So get a business valuation and put a stake in the ground. I would almost guarantee you, if you're a business owner, you're going to be shocked at what your business is actually worth. You may think it's worth more than what you actually do. And so having that business valuation and knowing where you are right now, so you can start doing things to increase value over the next year or two is paramount. Consistent accounting records with your financials and tax returns. Having some that are accrual versus cash. Different buyers are going to want to look at different things. So having clean books and records and not running your life through your business is going to be a lot better with selling your business. Monthly P&L and balance sheets and year to date, and having those ready to go. Having a up-to-date organizational chart, job descriptions and responsibilities, kind of like an accountability chart for those of you who may be doing the entrepreneur operating system, which I ran and implemented several times, and that's definitely something that would be good for your business. An employee handbook, your mission, vision, and core values, and having those things ready. The contracts with your clients, with your vendors, the leases, things like that, and are they assignable or are they not assignable? And making sure that they're assignable is very key when you're selling your business, because most businesses of the lower middle market size are asset purchases and not stock purchases. And know why you're selling. The buyer is going to ask you why you're selling, so know that answer, and also know what you're going to do next.
Couple little color and background on the valuation. The reason we feel like it's so important, even if you're not looking to sell down the road, is it's a huge part. Dan alluded to earlier. Most of the time, it's around 75% of your net worth. And so you've heard, a lot of people have heard the terminology paper millionaire. Most small business owners are paper millionaires. They look great on a piece of paper, but it's not cash in the bank. So understanding how a bank and a buyer is going to look at your business, and why your blood, sweat, and tears and all the things you've done to get to this place doesn't mean your business is worth way more than it really is. It's good to know that and understand that and embrace it. I mean, when you want to retire, selling the business should just help solidify your retirement. If you're burned out, then you just want to get some of that equity and turn it into cash and maybe take some time off. That's what my father did. He'd like to buy, grow, and sell, and he took time off, recharged the batteries, and went and did it again. And then just documenting everything in there. Dan said that the contracts, it's so important to have someone look over those and make sure you're doing the right contracts and make it assignable. And we always say is don't think about what you're retiring from, think about what we're retiring to. That why question is very important. I think the coronavirus was a wake-up call for a lot of the people that have their businesses that may have persevered through a couple other downturns. and all of a sudden they're thinking about, do I have the energy to charge another hill, or is it best now to maybe solidify my retirement, create some generational equity that potentially can go down the road, versus holding on the reins just a year too long where things start to decline, your energy starts going down, your business starts declining. And once you start going down, it's very hard for the buyers to know where the bottom is. And so a lot of times my biggest fear is that some of these people have great businesses, they'll just watch them wither over time down to nothing. And then, kind of our joke around here is, you don't want to see the guy or girl or lady or gentleman, break the key off in the lock on the way out.
Yeah, so there are a couple questions that came in as you were talking about that. And one of them was, what are some ways to increase business value, which I think you spoke to a little bit already, Dan, but I'm wondering if you can elaborate. And also, I had a thought as you were going along of, do you have a checklist or any sort of like printable PDF, like thing to pass on to clients of yours at all, or things that are good guides for people to look at?
I'm sure we've got one somewhere. Thanks for putting us on the spot, Don.
Yeah.
I mean, that's just my job.
After 24 years, we should have some sort of checklist. I'm sure we do somewhere. I wrote that down. Like, someone's got to have some. Hurry.
And we're very process driven throughout our whole process, but at the very beginning, to have a checklist of kind of the things I went over, very easy to create, for sure, to make sure everybody has those things like the org chart and the job descriptions and the employee handbook. We can definitely pass that along to Marissa to distribute. And you asked about gaining value in the business. Obviously, the two best ways to do that is to increase revenue and decrease expenses.
First time ever, right here live with Dan Wilson. Row top line.
Yeah, but there are so many different ways that you can do that. One of the ways that I help both of those, especially becoming a more efficient company, and the more efficient you become, obviously you can start cutting expenses. And implementing a business operating system like EOS or scaling up the Vern Harnish one, and putting something in that and getting your leadership team and your management team to buy in with that, and then starting to trickle it down all the way to all the different divisions in your company, you will start to see very quickly, and I mean quickly, like within 3, 4, 5, 6 months, you'll start seeing some areas that will kind of creep up to the top of where you can start cutting some expenses, getting more efficient. All of those little things add up to value. And one of the biggest things, and this is when I was looking at doing the merger and then starting to sell my company, I know as a business owner for like the first 12 years, I did everything I could to cut profit and all that. So the taxes that I would pay would be less and all that. But one thing I learned as I was getting closer to selling is, for every dollar that you save on your taxes each year, you're going to decrease the value of your company by $4 to $5. So let that sink in for a second. For every dollar that you save in taxes, you're giving up $4 to $5 on your valuation.
That is a interesting stat for sure, which actually leads into the other question that came in, which was, how much do business valuations cost?
Depending on what they're used for, you can spend a lot of money if you're debating or with a partnership dispute or a divorce. They can be $10,000, $15,000, $20,000. You can do a limited scope for $5,000 down to $2,500, and then we offer a lot if people just truly want to know what their business is worth, so they can use that with their financial professional that helps them with their retirement accounts, things like that, so they can kind of plug in where they are net worth wise and retirement wise. We have a no cost, no obligation valuation that kind of allows them to know where they are. We always say to people that you can't use something like that to go into litigation or negotiation with a partner buyout or divorce, or most estate attorneys are going to have the word certified, and we've got Abby is certified for us, so she can do those estate things. Those often cost $10,000 to $15,000 minimum.
Well,
Anything
thanks.
else, Stone, question-wise? We good?
I've got
Not-
one question.
Okay,
If
great.
someone is interested in kind of starting this conversation, they're interested in getting a valuation, what's the best way? Is that just going to your website, giving you a call? What's the best way to direct folks?
Whatever they're more comfortable doing. They can send an email in to Dan or I. They can call our phone number. They can inquire online. We've got a form online for evaluation. We're happy to help. We literally meet with probably 7 business owners, helping them with their valuation for every one that we actually engage. I mean, they're not ready, the timing, the price isn't right, or wherever that may be. So the earlier they start it, and then we recommend that they update that valuation on an annual basis. Share that with their financial advisor to ensure they're continuing to track well. If you got a good financial advisor, they got your home in there, they've got your 401k, they got your other investments in there. They may have rental property. They've got what you can expect to get from Social Security, which for our generation is zero. They've got all that in there, and then they're going to go ahead and analyze this out and say, okay, if you're going to live to be 95 because you or your spouse have a great chance of living to be 95, where are you in that spectrum? So if you don't have that key part of what your business is worth, you're not working with full data. So Dan kind of stole this from you earlier, so I'll just hit some of the highlights on the type of buyers and kind of maybe their perspective. So if you're looking to buy a business and you're an individual buyer, think there's 3 reasons you look to buy a business, right? Or 3 things you need from the business. You need the business to maintain your lifestyle, so think of a living wage. You need that business to service the debt that you borrow, and you need that business to provide you a return on your investment. So those are kind of the 3 things you need, whether you know it or not, the business to provide for you if you're an individual buyer. And when you're an individual buyer, there's 3 questions you ask yourself when you first go look at a business. And there's no substitution for looking at a piece of paper or seeing something online versus going in and actually physically touring that facility, meeting with the seller, and getting an idea of that business. And the 3 questions you can ask yourself are, can I see myself going to work there every day? Quality of life, it should be number 1. Business should never be ahead of quality of life, family, friends, health, things like that. So can you see yourself going to work there every day? Number 2, what do you bring to the table? Can you improve it? What are your transferable skills? Most buyers are not going to buy something they came from. As far as the industry they came out of, they're not going to buy something exactly the same thing. They're going to buy something different. So what do you bring to the table, and what do you want out of that business? Think about the qualities of that business versus the industry. A lot of people get hung up with, I don't want to own this, and say, well, why don't you want to own that? Well, I don't want to deal with people or whatever that is. Like, well, tough. That's gonna be tough for you. But find out the quality. Do you want to be inside or outside? Do you want white collar or blue collar? Do you want people to come to you, or do you want to go to them? Do you want business to business? I mean, those are the kind of questions you do. So what do you bring to the table, and how can you improve? And then third thing is, does it make financial sense? Which the first 3 questions we talk about will help figure that out. If you say yes to all those 3, doesn't mean you buy the business the next day. But if you say no to one of those 3, it means you move on. And being an entrepreneur means you're a risk taker and you're a decision maker. So if you want to buy a business, first you have to become a quick no is okay. And a long maybe is still a no. So say no and move on and try to find something else. Strategically, if you're already in business, you're looking to buy, then you're looking for more of that what Marissa and Don talk about, what they do at WorkSmart is that cultural fit. Does it make sense when they're buying? Are they buying for geography? Are they buying to buy the customer base? Are they buying to buy human capital? There are often times where business owners need human capital. And when unemployment was at 3%, and we know that 4 or 5% of America doesn't want to work, that means there's a whole bunch of people working against their will. So the best way to increase your talent was to acquire another company that already had good talent. So strategically, you're looking at how do you try to realize economies of scale? Are there ways you can cut? If you have 2 locations in the same city, can you combine locations so you have 1 light bill, 1 phone bill, 1 whatever? I mean, what are the things that strategically make sense to make that acquisition? Or are you bringing on another product line or service that you can offer your customer base? So you're combining customer bases, you're combining multiple services. So hopefully we talked about earlier, 1 + 1 = 3. And if you're a private equity group, which I don't think we have anyone on today, but if you're looking to sell and a private equity group wants to buy, they're going to have their own way of doing things. They're leveraging other people's monies, and it's all about growth. in 3 to 5 years, they want to grow that business tremendously. They want to maybe add on some additional businesses to that, what they call platform business, and they want to buy at a multiple somewhere between 3 and 7, and they want to grow it to where they can sell it to a bigger private equity group for a bigger multiple on a bigger cash flow. And so if you're looking at private equity, just realize that there's going to be a lot more tied to growth and earnout. You may need to buy in and retain some of the equity of the business. So you may get 75% of the value of the business cash at closing, and the other 25% may be out there for kind of an extended time period. And with the COVID-19, all 3 of these structures are going to change a little bit based on who's senior debt, who's lending the money, and how they're assessing the risk of this acquisition.
So we have one question that kind of came in around buying. Says, and while you're answering, we actually have kind of a little bit of a fun poll about why you might be interested in buying. So I'm going to post that onto your screen here in a second. But so the question was, how can I find a business for sale? And how do I know it, or how do I find the right business?
Well, the hard thing about our industry is it's antiquated and a little bit cottage. So we're decades behind the real estate industry. There is the biz buy sell, but if you found a firm and an advisor that you really feel comfortable working with, it's very hard for them to go out and truly assess every opportunity that's out there that may meet your requirements. So if you use an analogy of buying a house and you want to be in a certain zip code and you know the number of bedrooms and bathrooms, then a real estate agent can pull up on the multiple listing service every home that meets your expectations and kind of send you that to review. In our world, selling a business is so confidential that we can't post or put a sign out front saying, ABC Manufacturing is for sale. So with that, it's very hard in my opinion, very hard, sometimes very painful for buyers to really know what their options are out there. So unfortunately, they really have to be very active, very patient, and be very studious in reaching out to the different firms in their areas that they live in and want to buy business in to find out what opportunities are there. And then they may have to jump through some hoops, fill out a financial statement, send in a confidentiality agreement, send in their resume or bio, so that they're on the radar of the firms that are going to have opportunities that may match up with what they're looking for. So it is a little bit painful for buyers. Like we said before, it is a seller's market. So buyers have to be very patient, and they've got to kind of realize that they're being interviewed the same way they're interviewing the seller. The seller wants to make sure that not only are they getting a good price for the business, but that they're giving their business to someone that's going to put it in good hands. They're going to take care of their employees that have been so loyal to them for so long, take care of their customers and vendors. So you got to kind of say, why would this seller pick me over the other ones if there's multiple offers out there?
And I'll also add, we talked about seller preparation before and having that team and advisory team with you. And I remember the first acquisition I did, I came across the company, I approached them, they were interested, and we went through all the things, and I hired a lawyer that was a friend. I didn't have any other advisors on my team, and made a lot of mistakes. And some of them were costly mistakes. The second and third acquisitions I did, I didn't make that same mistake twice and all that. So if you're looking at buying a business, you do want to have that advisory team of the CPA and the financial advisor and attorney, and even an M&A firm that knows the process and can navigate you through the weeds to make it much easier for you.
And here's kind of our last slide. These are the questions we get almost on a daily basis. And in tongue in cheek, I would say, there's never you can't time the market same way when it comes to buying stocks, bonds, mutual funds. Same thing with selling the business. Price is going to be one of your main concerns, but it can't always be the number one factor of selling it. It really is. And when you think about it, most businesses about year 7 the business owners hit some sort of invisible ceiling of their capabilities, or they've hit a point where they don't want to buy that next product, that next facility, borrow that next loan to scale their business, because it does cost a lot of money to grow. And every time you do it as a business owner, I mean, you're personally guaranteeing everything. So the decision to sell really comes down to more of, are you burned out? Just because you sell doesn't mean that you can't own a different business at a different time in a different industry, because now you do truly have transferable skills. Your decision making is more concise because you've maybe made some mistakes in the past, you learn from them. So now you're more quick to make a decision. You've got cash in the bank versus that 75% of your net worth tied up in on a piece of paper. Now you've got it sitting in the bank, so you've got that comfort zone. You're in a different ballpark of what you can afford to buy the second time around. So it's always a good time to consider it, but it's more of a personal preference on that. As far as banks, they pause during the second quarter because they want to see what the floor is. Now they know what the floor is with this pandemic. They know that this industry is down 15% or whatever. Now they're like, okay, we know what the risk is. They are lined up now trying to do deals. There's still a ton of dry powder. People use dry powder, call it liquid cash, sitting on the sidelines, ready to be deployed into businesses.
Now I have a question about that. We talked about valuations. Is there anything that's changed around like how you do valuations or deal structures with the pandemic and the economy?
Yes, it's more important now than ever to really have your financials buttoned up so that we can think of a 2-hour movie. You've been in business for 20 years and say that equates to a 2-hour movie. We want to be able to go in there and snip this time period out and dissect it and put it up on the wall and show the buyer and the lenders and the banks and whatnot exactly what happened. And the only way to do that is have monthly financial statements, monthly balance sheets. Really look at, okay, what happened to net working capital requirements? How long did this persevere? When did they hit the bottom? When they start going back up? And now now we know where the floor is, and we can take that time period. And just because your business is up 20% or down 20% doesn't mean it impacted the value, because this 90 days is almost like a one-time event. Yes, this may repeat itself. Yes, maybe we may be wearing masks for the next 12 to 18 to 24 months. But the reality is this doesn't define a 20-year-old business. So we have that argument with some lenders and buyers, but we're sticking to that this doesn't increase the value of your business just because you're up during this time period, and you're not going to take a haircut just because the last 90 to 120 days have been a downturn.
That's really great to hear.
And then the last kind of question we hear a lot about is, and not trying to, again, be a smart aleck about it, but it's never too early to start planning. All these things take time. If you're like me, I'm still, after 24 years, I still sometimes gravitate to the urgent versus the important. And it's really, it needs to be said, you've got to start thinking about what's important. And exit strategy is up there. You start a business, like I said, we started this off with the only reason you start a business is to set up to sell it. And if that's true and you believe in that, you embrace that, then you need to always be in a position to be able to capitalize on opportunity.
I had one business owner tell me a few months ago, when I asked him if he was ready to sell, and his answer was, my business is for sale one day every week.
Yeah.
All right. Dawn, do you see any other questions on your end?
Yeah, so we had one last question in the queue now, but we have a few minutes left. So please feel free to send in more questions and, type furiously. So the last question that I have in the queue as of right now is, what determines your multiple?
Well, there are several things that can do that. The type of business that you're in, there's industry standards on multiples for different types of businesses. The amount of recurring revenue, if you're in a recurring revenue model business, you're going to have a higher multiple. Jay alluded to SaaS businesses, multiples are through the roof. But most of the multiples are going to range between 2 to 5 range. And Jay, you've got a lot more experience than I do. So what are some of the other factors that determine the multiples?
You got to think a lot about the intangibles. And so again, the multiple is the inverse of risk, right? The higher the risk, the lower the multiple. So how easy can your business be transitioned to somebody else? Customers, client concentration, vendor concentration. How active is the owner in the day-to-day, or does the owner have that organizational chart that Dan alluded to earlier, where they've got people in the right seats in the right bus, right place in the right bus, and doing the right things, and they know the job description, they do it well, and so that makes that business less risky because someone can step into my role and do it very easily. The more it's technical, special licenses, things like that, it makes the multiple a little bit lower because then you're looking for a smaller pool of buyers. So the more you can make your business easily transferable to a lot of different people and backgrounds, the higher the multiple is going to be. So it's all about, one, cash flow, and then the intangibles around that. And you can just think about intangible things you can't touch, tangible things. So just because you've got brand new equipment doesn't mean your business is more valuable than somebody else. It could. I mean, it could increase that multiple, but you also want to look at a lot of the intangible things of why your business may be more valuable than the same business in the same industry.
Yeah. There's a lot of
I
art.
imagine having a solid IT foundation is one of the things that makes you more valuable.
Absolutely. Absolutely. Yeah. You got the right vendors in place, right? That handle the things that you don't have to want to worry about. That's good.
Yeah. Well placed, Marissa.
I might be in marketing.
Yes.
Hashtag
any other
her
questions?
getting her job. We don't have any other questions in the feed right now. So
5 minutes early.
Yeah, you all just, you spelled it out so clearly and so perfectly for everyone. We know all the things now at this point. So thank you both, Jay and Dan. It was great to hear your wisdom and your knowledge and hang out with you. So we appreciate you spending some time with us on WorkSmart Live today.
Thanks, Don.
You're welcome.
Yeah.
Thanks for having us.
Yeah, of course. So before we send everyone out, I have a couple of updates on upcoming events. So I'm going to share my screen. You can see this panelist, right? Yeah, okay, cool. Just making sure. Alrighty, so next up on the Back to the Future WorkSmart Live series, you can join Marissa and I next week. We're going to be talking about communicating in the cloud and what that means, which we kind of got excited when we learned how to talk about what it is we're going to be talking about, is this idea of getting past email, like taking your cloud communications one step further than email. There's so many things that we have historically relied on email alone for, whether it's emailing ourselves reminders to do certain things or having that thread that goes back months and months and months and months. That's infinitely long. There's better ways to do this now, especially when we're all really distributed and dispersed. So we want to talk about what are the right tools and how do you decide what the right tools are for you and your organization. So join us next week. And then after that, we're going to be talking about file organization and data organization specifically in Microsoft 365. So I don't know if you've experienced this, but it drives me really crazy when I cannot find the information that I want and need from, whether it's HR or even in marketing. So we're going to kind of talk about files everywhere, and where do you keep those things in Microsoft 365 to keep yourself organized and maybe a little bit sane. And then after that, we're going to be talking about backup, because backup is so important, especially when we're all working in this distributed environment. So those are the next 3 events. And then because it's a 13-episode series, we have a few more things on the docket. We're going to be talking to our good friend, Becky Jacobs from Simple Change, about leading culture in your workplace and what that means, and all of her great tips and tricks for that. And then Marissa and I are going to be doing a 2-part Teams training specifically on meetings and videos. And then we're going to be looking at tasks and to-dos and this idea of the collaboration hub that we kind of keep honing in on. And then we're going to do some stuff on cybersecurity, virtual reality again, and then you'll hear from Clay. So lots of really good stuff that's coming up. So watch your inbox. Tomorrow you're going to get a recording of this, and then you'll continue to get emails from me about upcoming events that you can join us for. So that's all we have today. Again, thank you so much to Jay and Dan for your wisdom and your knowledge. Thanks, Marissa. You did awesome as always in co-hosting. And thank you all for joining us. So we'll see you next week.
Thank you,
Bye,
everyone.
everybody.